Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we stand here on the final day of the first half of the year.
Or the precipice of the second half after what's been a remarkable turnaround for stocks.
It has been stunning. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. And with the first half of 2025 nearly in the books, stocks are at all-time highs, with the S&P 500 on pace for its best quarter since December 2023.
With U.S. Treasury yields near two-month lows in just moments, we look ahead at what's in store for the bond market in the second half of 2025 with Rick Rieder of BlackRock.
And the race to Solana ETFs, the next generation of crypto funds, edging closer to availability for investors. You don't want to miss that conversation. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So I figured it's the end of June. We're halfway through the year, so let's take stock. And instead of looking at the weekly, let's look at the year to date, so the first half of the year, essentially. At the top, VU, 60 billion. Again, this is incredible. This is going to be 120 billion if we extrapolate. That would break the record that it set last year of 100 billion. So VU on another level, it just passed SPY also to be the biggest ETF. And I think it also just shows this relentless Vanguard bid, despite the headlines that we've been seeing, which I think also takes place in VTI and a little bit in the Qs. So again, a lot of equity buying despite the headlines that were pretty rough in the first quarter. SGov, though, is, I think, a byproduct of people's fears. This is cash. 20 billion for this is a large amount of money for SGov. You don't normally see it take in this much. And then Bitcoin. Gold is probably like number 9. So gold and Bitcoin also taking in a lot more than normal. So I think people are buying their stocks, but they're also buying some other things to hedge a little at the same time. Let's look at the outflows here. And you'll see SPY at the top at 22 billion. Now, that is a lot. Some was from December tax loss harvesting outflows, but some is from the migration from SPY to IVV and VU, which are cheaper, and SPLG. IWM, I've been doing this for years. I just almost feel sorry for small caps. They just can't catch a break. People try so bad to make them happen, and they won't. More money out of IWM. Energy, some bond ETFs here, and there's some EFA. So again, though, mostly inflows. And let's look at those net inflows into all ETFs, which are 550 billion so far this year. I was shocked. Normally, the market has to go up like 20, 30% to get this kind of flows. Market's only up 4 or 5%, and still, so far, we have 550 billion. So we're going to extrapolate and say we double this, plus Decembers are usually a little bigger than normal, so we get to 1.2 trillion extrapolated. That would be a record. So we are on a record pace, and last year's record blew away the old record. So we're talking about beating a record the hard way. So again, I think ETFs, the vehicle of choice, that's part of it, Katie. But the sentiment also, despite the headlines, pretty strong.
All right, Eric, I'll pick it up from here. Eric, thank you so much for that setup. Joining our conversation now, I'm pleased to say for the entire hour, is Rick Rieder. He is CIO of Global Fixed Income at BlackRock. Rick, always a pleasure to see you.
Thanks for having me on. Appreciate it.
So let's set the scene. We talked about the first half of 2025. At the start of the year, the 10-year yield was at 4.56%. It rose to 4.8% shortly before Donald Trump took office. After Liberation Day, it sunk to 3.86%. Now we're stuck at around 4.27%. That's a pretty wide range, and it feels like everything has been priced in at some point during this year. What's not priced in?
So I'd say, well, what's not priced? So, by the way, I'd say a couple of things. By the way, the best return opportunity this year across debt and equity markets is to sell volatility, because it's been actually pretty amazing. Like you talk about these ranges. The markets tend to move one way, and then you could sell one side of it, and then the other, selling volatility rates and equities has been a good trade. What's not priced in? Listen, I think there's something that's going to happen over the next year or so that I think is pretty spectacular. One, I think it's pretty clear. I was watching the interview with Secretary Bessent today. Fed is going to bring rate down. Second thing that's happening, you know, you've had, and he talked about it, inflation has come down. The 3-month moving average core CPI is 1.7%, pretty impressive. The thing that I think is not priced in nearly as aggressively, what's going to happen around automation, productivity, robotics, AI, is actually we're going to move to a place where we're going to reduce the rate of inflation on a persistent basis. And I think that's the thing that people are going to focus on. Part of why I talk about buying the 5-year point on the yield curve. You know, people say, where are the forwards priced? I think it's something that's going to be pretty interesting. Part of why I know I've said this is a golden age of fixed income, not because we're going to make a lot of money in interest rates. You're getting income now that's pretty spectacular.
Right.
Where we're entering a point in time that's pretty exciting around how the world's going to change.
So you just said a whole bunch of interesting things. I want to focus on what you're talking about, when it comes to the long-term effects of AI and other forces, when it comes to inflation, then that'll be a downward force when you extend the time frame a little bit. Can you invest around that rate now? Because maybe that's the long-term picture, but there's plenty of fears about inflation in the short term.
So the answer is yes. I mean, you look at it in the equity market today, not just the traditional hyperscaler investments, but as well the companies that are involved in cloud, software, energy, cooling. And you think about how well, you had the DeepSeek thing in February, which was, I like in our global allocation funds, I like tech, I like investing alongside this space. That was a wake-up call, like you still got to be careful about your beta. Technology's changing, but I think that paradigm is real. So then you talk about, so let's relate that to what does it mean for interest rates. I think people underestimate. I mean, we use AI in functionally everything we do now. It's going to change the world. Wow. And it is going to change the world around increasing productivity. By the way, for the U.S. economy and for the debt situation, if we get to a place where you can grow faster and you have a more productive economy, it means great things in terms of bringing the debt down, which I still think today is the biggest tail risk we have in the system. But if that plays out, if that economic transition plays out, that's pretty powerful.
I want to talk about the Fed and cuts. I just did a snap poll on X, and most people think 2 cuts. That seems the majority. Second most would be 1, and then 13% said 0. I am in the 13% camp. I just don't see the need for it. What's the problem here? Why cut rates? Why change something if it seems to be going so well right now?
So I throw out one thing. So you think about the Fed raised interest rates 500 basis points. What was the impact on the economy? Not really debilitating. And I think one thing that we've learned, U.S. economy is not that interest rate sensitive. Technology-oriented, service-oriented. Most companies that fund CapEx today, the big hyperscalers we're talking about, don't borrow. They do it through free cash flow. The interest rate tool is incredibly blunt, except for one thing. The housing market is incredibly sensitive to interest rate. We have a housing problem in the U.S. economy. There's not enough inventory. And I've said this before, Fed brings interest rates down. You actually reduce inflation because what happens today, home builders are subsidizing mortgages. Why you saw this at KB Homes. You've seen it with a number of the home builders. You can't sell houses until you subsidize that mortgage rate. So they don't build enough houses. Inventories stay too low. Inflation, shelter inflation, which is the stickier part, doesn't come down enough. My view being, actually we got to get that mortgage rate down, and we have incentivized people to build houses. I don't think, by the way, you cut rates, you're not going to increase inflation. If anything, I think you reduce it. Listen, I think you got a bit of room that you can move the rate down. I think I'm in the 2 camp. I was still in the 2 camp when we were at 5 cuts 2 months ago, but I think they can do it, and I don't think it'll be debilitating, certainly to inflation.
You mentioned Scott Bessent, the Treasury Secretary. He did speak with this earlier today. Let's take a listen to what he told us.
I think that we could see a further lowering of rates. I think inflation is very, very tame. I'm not going to comment on Fed policy, but I've said that I am focusing on the 10-year. So as we see inflation come down, I think the whole curve could parallel shift down.
As a Treasury Secretary who's focused on the 10-year, what influence, what sway does he have over it? How does he do that?
So there's a couple of things. One, I think he made a comment about not issuing as much. Why would you issue further out the curve? The Treasury Secretary can influence the size of auctions, how much you issue out the curve. Wait until you actually get inflation down, then start extending the term. Listen, we got to extend the term of the debt out. I think the point he made, which I agree with, we don't have to do it today. Let the whole curve shift down. I still think the curve will steepen. I think the front will move more when the Fed moves. But as long as you keep that issuance down, and then rates will come down, then start to extend the term out. The true tools to keep the back end down sit at the Federal Reserve. At some point, the Fed could do an Operation Twist. You can get the back end down. And I think there are tools like that that the Fed can employ pretty, and they've done it before.
I want to take a turn here, and I want to talk about public versus private, because you think about some of the hottest debates in the ETF world, and it's what are we doing with private credit? You made the comment last week, I believe it was at the Morningstar conference, that you see lines blurring between public and private debt, and I think a lot of people would agree with you, but I want to talk about where that blurring might happen. Do you think that the ETF wrapper is a suitable place to have that conversation?
I do. So, one thing, when I look at any asset today, I look at marginal contribution of risk, what it does to a portfolio. what it does to your beta, what it does to dispersion, what it does to liquidity. And when I think about a private, it's like, okay, now I've got to haircut liquidity somewhat, although that's changing. Privates are becoming more liquid. So today I look at it and say, okay, that's another asset. I've got to manage my liquidity, I've got to manage my beta, my dispersion, et cetera. I think what's going to happen going forward, when I look at doing bilateral credit, a real estate financing transaction, listen, those assets, A, are becoming more liquid, and B, if I can get an IRR that gets me an extra 300, 400 basis points, like that asset is beautiful in an ETF wrapper as well as in a, now I think when something's in an ETF wrapper, you think about, and I think about this in Bink and a bunch of our portfolios, I've got to make sure you can do redeem and creates. I got to make sure your beta is consistent. So I do think you'll see more in an ETF wrapper. Listen, I think ETF wrapper in many ways is the future because of the way people build models and think about it. So yes, I think it'll be part of it. And I think the liquidity of a lot of these privates is going to grow quite a bit as well.
Interesting. Rick, we're just getting started. Sit tight for just a couple minutes. Coming up, we're not actually going to ask Rick about it, though it would be fun. We're going to talk about the race to launch Solana ETFs heating up. That conversation up next. This is ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the Grift ETF. This is a very fun filing from none other than Matthew Tuttle. The application is for the Tuttle Capital Government Grift ETF. Basically, it would aim to hold companies that profit in some way from political influence, whether it's members of a presidential family, whether it's members of Congress. It would charge 75 basis points per year to do that if it does launch. The proposed ticker there is GRFT. Let's talk a little bit about mutual funds on ETF IQ, because I thought this chart was super interesting. We talk about the active boom in ETFs all the time. Turns out the mirror trend is underway in mutual funds. You have passive assets in white there, and you can see it's converging with those blue active assets. So we'll see if we get to 50-50 in the mutual fund industry. But let's talk about Solana a little bit. I haven't thought about this in a while, but apparently Wednesday we could see a Solana ETF launch, and could be the start of a new trend when it comes to the crypto industry in the ETF wrapper.
All right, let's bring in Eric Balchunas with more on this, because you and your colleagues wrote a mid-year outlook that talks a lot about this. Where's the demand for a Solana ETF coming from?
There will be less and less demand the further away you get from Bitcoin, no doubt. That said, you're still on like altcoin number 2, right? So you're within the realm of like possible assets. And Solana is, we had Anthony Scaramucci on. That's his favorite altcoin. Cathie Wood, it's her favorite altcoin. So they're, one of these altcoins is going to go on a nice run and it'll get assets. It could be Solana, we'll see. But the race to launch it, as you know, is vicious. I mean, so we got this Rex trying to cut the line and launch a 40 Act Solana ETF when all these 33 Act ones are waiting their turn. And it's created a lot of friction in the industry, a lot of questions. But, this is how Priv kind of came to market.
Yeah.
We call it maybe running a stop sign or a yield sign and just getting out there, because being first to market can be huge.
The SEC famously loves when you do that, if we put this back to the Priv example.
Yeah, they do. Here's the thing, though. With Solana, there is a Solana future ETF out that holds futures. It only has like 20 million, so not a huge amount of interest there. But it does lag a lot. People don't like futures. Like this new ETF from Rex is going to be 40% other Solana ETFs, because you have to hold securities to be in the 40 Act. The 33 Act ones will hold spot Solana. And I've found that over the years, people like the real thing. But this also is 1.4%. And the Bitcoin spot ETFs were all 20, 25 basis points. So between the fee and not holding pure spot, I'm not sure if that will matter. But being first is important. So there's just a lot of interesting variables at play. As an analyst, this will be an interesting experiment to see who gets the assets, where they go. But yeah, look out for SSK launching this week.
All right, can't wait to see who wins that race. All right, Eric Balchunas on the upcoming Solana ETF. Still ahead on ETF IQ, we've got more with Rick Rieder, the global CIO of fixed income at BlackRock. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, hit it.
Katie, today we're looking at BINC, who is the ETF managed by Rick Rieder, who's with us today. The iShares Flexible Income ETF. It's a multi-sector active fixed income ETF. We've got the bond manager. And this is interesting here. Look at the expense ratio, 40 basis points. This is something we're seeing in the ETFs. You get these 40 basis points or lower fees, brand name company, big manager, and it's working, right? A lot of value for a low fee, and here you see why it's got $10 billion. This is going to be one of the fastest growing active ETFs ever launched at $10 billion in 2 years. Let's look at the asset allocation breakdown here. There's a lot going on here, but you want that from an active manager. You don't want somebody like hugging the benchmark, right? So you've got asset-backed securities, commercial MBS. You've got U.S. is only 60%. You got a lot of Europe in here. That's interesting. We'll discuss that. Look, you've got double B is 27%. That's high yield. So you're going to have a little more high yield kick in here. The duration, pretty mixed, but I'd say 3 to 5 is the most popular. So a little bit shorter end of the curve. And look, corporate, mortgage, and then government's only 10%. That makes it very different than the ag. So let's look at the performance of BINC versus a bunch of other popular iShares bond ETFs that you love and know. So you can see it's outperforming AGG by over double. It's outperforming LQD. It's slightly underperforming HYG. And it's really outperforming GOVT, which is the whole curve in one ETF. So you mix all that brand, the low fee, and these returns, it's not a shocker. It's got $10 billion, Katie.
All right, well, let's talk with the man behind this ETF. His name is Rick Rieder of BlackRock. He's with us now. Rick, when it comes to BINC, I mean, we've been watching it closely since it launched in May 2023. Where we're sitting in June, at the end of June of 2025, when you think about the universe and what you're trying to accomplish with BINC, what is your highest conviction right now?
Listen, income is a beautiful thing. I think, like Eric said, so, we're trying, as Eric said, we're a bit behind the high yield index. Our drawdowns are about 45% of high yield, so meaning our volatility is much lower. What we're trying to do is create stable income, almost the exact same yield as double B high yield, but with a rating that's high triple B. We're actually on the verge of being single A rated. If we did a couple of things, we'd be close to. So if we can keep our volatility down, create a high yield like yield, and then, by the way, as Eric said, I mean, the 3 to 5 year part of the curve where we think the volatility is low and will benefit if the Fed cuts rates. What am I most excited about in it? Eric brought it out. We own more Europe than I've ever owned before. Why is it? The flip side of tariffs, et cetera, is you now get, people are hedging the dollar. We get a 2.5% benefit from buying European assets. For the last, you think about 2014 to 22, remember in Europe they had negative interest rates. So we were lending money to companies at negative yield. Today, if I buy even investment grade Europe, I get a roll on the curve, I get the 2.5% additional, so I'm buying credit at 6 to 9%. I'm buying things like Spain. The government of Spain, if you take the roll on the curve, because it's a steep curve, you roll down the curve, and I get that currency benefit, I'm getting almost 7% for Europe. That to me is, and you think about where we're going to be a year or two from now, ECB's got to get the rate down. We'll see where the currency goes. But that to me is like buying Europe. As a bond investor, I'll buy equities in the U.S., but buying bonds in Europe's phenomenal.
That's not treasuries. That's government debt out of Spain. What about corporates out of Europe?
No, I love it. I love it. I mean, so European, I've reduced some of my investment grade because you're not getting that much additional versus what you get in Spain or Ireland or some of the other rates markets. The second thing is, I like the fact that you're getting in high yield, you get that additional, and European loans, and like the top part of AAA CLO in Europe. So if I can stay more in high yield in Europe and credit quality is really good, do I need the investment grade if I can buy peripherals? I've been buying a lot of agency mortgages in the U.S. So investment grade I've reduced, but it's just not that incrementally beneficial.
Now, we talk about treasuries. We did talk about Europe more in the mid to shorter end of the curve. Let's talk about the long end of the curve. I feel like TLT, which is the 20-year bond ETF, is for people who like to overthink things. I feel like it's like, oh, the numbers are going to say this, the Fed will have to do this, and you're doing 3D chess, and it has incinerated money over 4 years. It's down 38%. Why isn't it doing what all of this money thinks it should do? I'm not a big fan of the back end of the yield curve. I think at the end of the day, think about what we get in yields in Europe.
Like, why wouldn't I just take that? I'm at the front end, ECB's got to cut rates, or I can be a thrill seeker in the long end of the yield curve and hope ultimately rates come down. I think the curve's going to steepen, so I like buying the front of the belly. There's going to be a point in time where TLT, last couple of days I bought some long end. There's tactical things around month end, quarter end. So, there are times to be in the long end. There's going to be a point where, gosh, we're going to want to own some duration. TLT allows you to supercharge that duration. But I think it's, I don't think it's the soup of the day today, but I think there's going to be a point in time that by the way, it's more efficient than a lot of blended indices. Like if I want duration,
right,
that thing is a beautiful vehicle to get there. I just don't think we need it today.
Well, to that point, I'm taking a look at the fixed income outlook that you released today. You write that basically duration is no longer the reliable hedge that it once was. So with that in mind, I mean, Eric says that it's for people who like to overthink things, but do you think that people are still buying the back end in hopes that it will act for a hedge? I just don't understand what the calculus is.
I mean, there is some, by the way, if you think geopolitical comes back, owning some long duration can be helpful. I think listen, at some point, when inflation comes down, owning that back, it'll make some sense. Today, the correlation with equities, so, markets move on themes. Today, the theme is, what is inflation going to be? Are tariffs going to be a problem? Is it a one-time price adjustment? If what's going to happen is the back end of the curve will correlate with the equity market. Today, I'd rather buy equities. Equities generate 19% ROE. So you think about if my book value of my equities going up 19%, I compound that over 2 years, or I buy the long bond under 5% with inflation running, we could debate where that is. Like I'll take the equity, particularly growth equity, all day, and then marry that to income.
So just to really, and we only have like 30 seconds left, so this isn't fair, but just to make sure I'm understanding, you'd rather buy equities than long duration bonds?
Yes.
Okay.
Yes.
All right.
Matt, within a portfolio, part of why models are beautiful today, part of why ETFs are beautiful, is like I'm owning equities for upside and convexity and growth, and I'm going to own income to marry to it effectively.
All right, well, that's a beautiful place to leave it. Rick, this has been fantastic. Really appreciate your time kicking off this week. That is Rick Rieder of BlackRock. You can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter, Bloomberg.com/ETF IQ newsletter. That does it for Bloomberg ETF IQ, the TV show. This is Bloomberg.